Hello and welcome to Portfolio Matters, weekly markets checklist, week 202. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Well, thank you, Richard. Before we get going, some housekeeping. This will be the last one of the year because we are both very busy over the next couple of weeks, but we will return in the new year. Portfolio Matters is going to change a bit. Clearly, you will all know I've had a terrible couple of years as my investment approach has failed, basically. So we're going to change, and I'm now going to be looking at investment themes and taking some advice from all of you and from Richard. So every week we will be having a section on investment themes and what the market is concentrating on, and I will be aimed to be following the market rather than fighting it. So the news this week. So the Fed met, it cut rates by 25 basis points to a range of 3.5 to 3.75%. It also restarted bond purchases. Now this is QE light, as Richard has been long predicting. And that basically put a rocket under precious metals. We'll show you the charts in a minute. Bank of England meets later this week, and despite UK inflation remaining well above target, it is expected to cut rates by 25 basis points to 3.75%. Ukrainian and US envoys are currently in Berlin, where they are searching for a peace deal. Ukraine has accepted it will not be able to join NATO. Now, I think, and I'd be interested on Richard's opinion on this, but it seems to me Ukraine is being forced into an unfavorable peace, and that will have actually some quite big impact on various markets, in particular the oil market, in that I think Trump is likely to remove sanctions on Russia as soon as he possibly can, adding more barrels to an already oversupplied oil market. And will the EU turn around and start buying Russian gas? Question mark. Richard, what are your thoughts?
I think that Ukraine is in an invidious position. The EU stroke NATO can't step into where the US was. I think they can't because they don't have the material. They don't actually have the solidarity either.
Mm.
And the US is stepping out, and you can't actually blame the US for stepping out. You may think it's a bad thing, but they're doing what they're doing. So that means that there has to be a peace between Russia and Ukraine, and Russia holds most of the cards.
Yeah.
So I think it wants Odessa. I think it'll get Odessa as a warm sea, Black Sea port. And I think we will then be effectively in some sort of stasis,
Mm.
an armed neutrality between Russia and the EU, and the EU is going to have to, or NATO, I think in this case that's all interchangeable really, they're going to have to significantly rearm, and they won't be able to face Russia off militarily for 10
Mm.
years. And then maybe the status quo changes, or maybe by then Russia's made a move on Lithuania and so forth. I think it's
Mm.
really, really difficult situation. In terms
Yeah.
of oil, I think that there's a lot of Russian oil has been leaking into the into the worldwide oil market anyway. So how much more would get out currently if sanctions are relieved? I don't know actually. And just in terms of the oil glut, there are counter opinions that say there isn't an oil glut, and we are heading into a fairly significant oil shortage. And I think we need.
Well, let's discuss that when we get to oil.
Sure. Okay. So yeah, that's my view. So I'm not quite sure what impact it'll have on your market.
Okay. Spoiler alert. I bought some Forexpo this morning, the Ukrainian iron ore miner. I think there's a juggernaut heading towards peace, and you know, like it or not. Um, Talking about the oil glut, the IEA has revised its forecast for the size of the oil glut in 2026 by 250,000 barrels a day, but still it's going to be an enormous 3.86 million barrels a day on average in 2026. And we've got a chance coming up about whether Russia is successfully exporting its oil. If there is peace in Ukraine, that can only add the size of the that addition we can argue about, but it will lead to further barrels on the market. Elsewhere, the US seized a Venezuelan oil tanker in international waters this week. International law seems to be totally out of the window, and it is saying it's going to sell that cargo. Oil rose a little bit, but failed to sustain the rise and is down on over the past couple of weeks. Turning to economic news, we had UK GDP numbers, and I'm afraid they were very poor. In October, the UK economy shrank for the second month in a row, and the NIESR, which has a monthly UK GDP forecast, it says November was also negative. So the UK economy has been poor. It seems to be weakening further. In the EU, by contrast, Q3 GDP was revised up to plus 0.3% quarter on quarter, 1.4% year on year. And Christine Lagarde has been saying that the ECB is likely to revise upwards its 2026 GDP forecast because the Eurozone economy has proved resilient to US tariffs. US PCE inflation for September, yes, September, so it's out of date, but the BLS is still catching up from the US government shutdown. PCE inflation rose to 2.8% in line with forecast, but core actually missed. It weakened by 0.1% to 2.8%. Goldman Sachs is forecasting that US inflation will come down in 2026 to end the year at 2.2%. The good news for the US was the JOLTS job opening numbers for September and October were published, and they showed a bounce, quite a strong bounce to 7.7 million job openings. Further signs that the US jobs market may actually be stabilizing. China, however, fell back into deflation in November. CPI fell 0.1% month on month. The Chinese trade surplus has hit $1 trillion. Market news, equities were mixed. Nasdaq was down, Russell was up. So there's some rotation actually out of tech into the real economy. Energy markets were generally weak. Industrial metals were mixed but generally drifting up. Precious metals were to the moon. Richard will be ecstatic. Charts relating to the news, well, this is probabilities for the next Fed rate cut, and you'll see that they're now forecasting that the Fed will cut twice in 2026. The first one in April or June, and then one again in September. And the Fed cut rate, despite inflation remaining persistently above target and despite revising GDP growth up. They remain concerned about the jobs market, but as we showed you, the JOLTS number suggests the US labour market may be stabilising, in which case the market could be too optimistic about future rate cuts. And this is the size of the Fed balance sheet. It's expanding the balance sheet once again. QE equals liquidity for the markets equals number go up for everything. Finally, Donald Trump. Are Americans beginning to tire of the chaos? This is his approval rating. And in particular, they are fed up with rising prices and the cost of living, which is in part a result of tariffs. And he is denying there's any cause and effect, but clearly there is. I found this really quite salutary. This is his approval rating by category, and uh, none of them are positive. And that matters because in 2026, you will have elections for the House. And if the Democrats win, then Trump is going to find it increasingly difficult to enforce his agenda. Finally, the Bank of Japan meets this Thursday and is expecting to raise interest rates. On to equities. Richard.
Thank you, Keith. Yeah, quite a fortnight for the FTSE World and all share indices. Not very much move, 0.3, 0.1% up respectively. Stocks Europe up 1%, S&P down 0.3%, Russell 2000 up 1.6%. Nasdaq and Hang Seng both down by 1.1%. The topics up by 1%. So small moves there. The year to dates are really between 15 and 30%, depending on which market you look at. So year to date markets have all done very well. Bitcoin was down 3.5%. And now down 2.5% year to date. The pound slightly up against the dollar, as was the euro. The pound's now up 7% year to date. And the dollar index down 0.7% over the period and down nearly 10% for the year to date. Mm-hmm. With the VIX, it was up a little bit, but it's down 5.7 in the year. So with FTSE All World Equity Index.
Yeah, that does seem to be topping out, to be honest. Last couple of months.
Yeah, it's difficult to know, isn't it? It's a QE restarting.
Yeah, true.
There's the FTSE All Share. I wouldn't bet against any of these markets, frankly. Euro Stoxx 600, S&P 500, and Nasdaq Composite.
Yeah, had a great run.
Yes. The Russell 2000.
Now, I think the Russell 2000 is actually really interesting and potentially important because this is small companies, the mass of the US economy, and the bounce back suggests the market thinks that the US economy is actually strengthening.
I would agree with that, yeah. There's the Hang Seng, which had a good year. It was a little bit sleepy last few months, but had a very good year. The topics, basically, is just on a steady upward trend since May.
This is your point, Richard. This is monetary debasement in action.
Yeah.
You can keep on printing money and you can keep on suppressing bond yields, but what you can't do is maintain the value of your currency as you do that. So the yen keeps on falling and topics are rising as the earnings of the bigger exporters keep rising.
I think that for a similar sort of reason, I think the US market is not going to have this crash that various commentators talk about repeatedly and have been for years. I think it's the US government can't afford for it to crash because it gets its tax revenues via recycled government debt, there's so much debt going into the economy, and with the QE, it might have a little bit of a correction from time to time. I'd be very surprised if it crashes.
Well, the thing is, I think I continue to believe AI is ludicrously overvalued. And the growth expectations of things like Nvidia will not be realized. But when you look at the world economy in the coming year, oil prices are low and falling, and that is a huge stimulus to the world economy. And interest rates, frankly, are coming down, or it's like the base rates coming down. And I can't really see any catalyst for a recession at the moment. I can see that, the world GDP growth. As the cycle evolves, GDP growth may be slowing, but I can't see any catalyst for recession. Now, if the AI bubble bursts, there's a question of how bad that's going to be. And
Yeah.
your point about keeping the equity market up, the wealth effect in the US is enormous. And at some stage, I think the valuations of these AI stocks is going to have to come down. Whether that causes the thing is, fundamentally, I don't think they're big enough to cause a worldwide recession. I think the size of the bubble
Also,
is not that big.
yeah, they don't need to crash either. An Oracle fell by a
Yeah.
chunky amount last week, didn't it? And that's fine, And if Nvidia were going to fall by 20% next week, it
Hmm.
wouldn't really matter. I think if they all fall by 60% at the same time, that's a bit problematic.
Yeah.
But if the air is just deflated out of it gently, then it's
Yeah,
simply
no, I agree.
market will adjust.
Yeah. So I think basically I have to be nimble is my
Yes,
new thought. I'm
yeah.
going to be nimble.
But certainly steer clear of the
Yeah.
AI companies. So there's Bitcoin. I mean, there are two schools of thought on Bitcoin, aren't there? One is it's an asset that is worth nothing, and one is it's an asset that's going to be worth a huge amount of money. I'm sitting on the fence. I'm waiting to
Well,
see what happens.
I'm firmly in the it's like air at camp. I think there's no value there at all apart from, selling it on to the next sucker. Or unless you're a drug dealer and then, one needs to make international payments, then it does have value.
Yeah, it has certain facets of being a Ponzi scheme, doesn't it?
Mm.
Um, there's the pound against the US dollar,
Yeah.
the euro against the dollar.
The fact that the sterling is rising against the dollar says all you need to know about the dollar.
Yeah, I'm slightly puzzled by it, actually. There's a dollar index. The dollar index is down to nearly 10% of the year to date. Interestingly, it used to be the mantra that gold was tied to the dollar, and clearly that was fundamentally mistaken. And gold is not
Mhm.
tied to the dollar because gold is up, I don't know, 60%
Yeah.
it's a year to date. So there have been various sort of canards put around the market for a number of years about gold and how it relates to how it correlates one way or another with other assets. And in many senses, it just doesn't.
Yeah.
There's the VIX, which is really low, just as
Yeah.
the government wants it.
Well, the market doesn't see any risks currently.
No black swans in sight, as someone once said to me. I didn't
Mm.
point out the obvious, which is you can see
Yes,
it is not a black swan.
precisely. If you can see it, it ain't a black swan.
Foreign investors have been a big driver of US equity returns this year, so we've been jumping into the market, presumably into AI stocks.
Yeah.
Forward PE ratios, large, mid cap, and small. So you can see that the forward PE ratios of the Max 7 are high.
Yeah. Now, going back to our earlier conversation, Richard, I mean, this is the fundamental point, is that when you look at the P ratios of the great mass of US companies, they're not overvalued.
Yeah,
Everything, it's the Mag 7 and the AI stocks. So, as long if the AI stocks were to fall back to earth, then the Nasdaq might crash, but it's not really clear that there'd be that much effect on say the Russell 2000 or the stocks that outside the Mag 7.
my suspicion is that the air will just slowly leak out of
Yeah.
these shares, and they'll come back to whatever is an appropriate valuation, whatever that might be.
Yeah. Well, we'll just have to wait and see.
We will. And there's the S&P XAI, which is not particularly expensive. So
Yeah.
yeah, and then the overall market is relatively expensive, which would suggest that there should be lower returns going forward in the
Yes.
future.
How often have we said this?
Yes, well, at least for 4 years, I think, Keith.
Yes.
So the AI bubble, I don't think the AI bubble is going to burst, but I think it will. I think it will slowly deflate. I mean, I think Nvidia, how do you pronounce the bloody name, is going to deflate.
Yes.
Google Google, however, is doing extraordinarily well because it's
It
got
is, yeah.
its new tensor chip, hasn't it? Which is basically
Yeah.
causing serious harm, or potentially causing serious harm to NVIDIA. So Google's flying high, and NVIDIA's on the receiving end of some competitive stress. So, the signs are possibly there that what's actually going to happen is that these things will start to be valued on a more rational basis going forward.
Yes, you're right, Richard. I take back the title of this slide. What it should say is the market is becoming more discerning.
Yeah, yeah, I think that's right. So it's just a reiteration. The bull markets can last a very, very long time, but the bear markets, the big corrections, are rapid and very, very nasty.
They can, yes, that's right. And now, I was reflecting over my terrible year, or terrible couple of years, and I was thinking that what causes, let's go back to basics. What causes a recession? And it generally, actually, since we've had independent monetary policy, it's two things. Either an exogenous shock in the form of a stock market bubble bursting, like .com, or it's the oil price going to the moon. Now, the oil price ain't going to the moon. It's rather doing the opposite, which will be actually a tailwind for the world economy. And
Well, I have to caveat
go on.
that, Keith, say if you're right.
Yes, if I'm right. Well, yeah. Okay, well, we'll talk about that when we get to oil.
So this is a chart that shows that the best way of growing your money in the long term is to be invested in the markets. They have their minor. At the time, they don't necessarily feel minor, but in retrospect, minor blips. But
Yeah.
the upward direction is really very obvious there, and very significant as well. High beta stocks continuing to outperform low beta stocks.
Yeah, Mark bullish, frankly.
Cycle also outperformed defensive for the past 13 days. There's that big spike over on the right-hand side,
Yeah.
which is perhaps a sense that the market thinks there's a better growth outlook coming.
Yes, exactly.
Shift into cyclicals. So this is showing that the actual returns over the market following 12 years from whatever valuation we're at now. This is predicting that the actual return for the market is going to be negative over the next 12 years.
Yeah. Now, the thing is, we've shown various charts like this where you look at valuation and 10-year, 12-year forward returns, and they work very well until last 2 or 3 years. Now, has the model broken down entirely, or will it revert? I suspect it will revert at some stage, but perhaps, as you've said, the if we're entering a period of monetary debasement and fears over monetary debasement, that may not be true. There may have been a phase change in the markets, and people are buying equities over. There's a fundamental shift into equities and commodities away from bonds because people fear that governments will eventually default either through formal default or through inflation.
Yeah, it's interesting, isn't it, that the biggest we don't have that much data because of this 12-year lag, but the big deviations really began in the early 2000s.
Yes.
The early 2000s, very approximately, was when governments started to print. I say print when they issue debt. To my mind, is actually printing money. That's when government debt really started to expand very significantly. And I suspect that what's happening is that all of this government debt around the world has distorted all sorts of trends that didn't used to be distorted. There's a distortion in the Second World War as well, isn't there?
Yes, that's right. Well, we've got a really important chart on global debt levels coming up. We'll discuss that again then.
And then available cash as a percent of market cap for investors. So they're all in, as in they've actually got some margin. In net, in total, there's margin in there as well, isn't there? Mm-hmm. And assets under management in leveraged ETFs at quarter's end. We should rehash the dangers of leveraged ETFs at
Yes, we
some point,
should.
Keith, because that.
Well, the trouble is, Richard, I'm embarrassed to say that it's worked for the Nasdaq because the thing is, these leveraging ETFs, if there's any volatility, they're a total disaster.
Yeah.
But if it goes up day after day on no volatility, they work. And
Yes.
actually, the Nasdaq has been marching steadily higher on low vol. So actually, holders have done quite well. Now, the past is not, a
No.
necessarily predictor to the future. And in general, these leveraged ETFs are a very bad idea unless there is a consistent climbing trend. And actually, what's been remarkable over markets, commodity markets, the last couple of years, is that volatility has been so low. Now, your debasement theme would seem to explain quite a lot of that.
Yeah, it would. You're quite right, though. Yeah. So that's. Don't all
Mm,
jump in, though.
yeah.
Excuse me. And at the moment, the market is being driven by rising valuations as opposed to rising earnings.
Mm.
So we shall see. And as I think we all know, the market is being increasingly held up by the AI CapEx boom. And one of the things we wonder is whether Sam Altman is actually ever going to pay off all the money he owes to all these other companies for the contracts that he signed. And
Well,
time will tell.
but the thing is, but Richard, on your point, I don't think the market really believes him. And I think, when you look at Oracle,
Yeah.
share price is falling and market marches on. The thing is, OpenAI is relatively small. I mean, it's a huge company, but it's a relatively small part of the US economy.
Yeah.
And what it's showing is the market is very skeptical. So if it fails to materialize all these investments, etc., I don't think the market will really be affected because it's already skeptical.
Yeah, you could well be right, Keith, actually. Yeah. And yeah, so hyperscalers are putting so much investment, obviously their depreciation is becoming
Yeah.
a significant drain on their P&L accounts. And that's
Mm.
so there's a lot of depreciation coming through.
So, I mean,
I did read that uh, the depreciation policy for some of these NVIDIA chips may be too aggressive in that fact that they will continue to be functional for many years.
yes, I agree. Yeah.
Maybe we even discussed it the other week.
I don't think we did, but you're right. It depends on, whether a lot depends on whether customers demand the absolute highest performance, etc. And I
Yeah.
suspect they won't.
I mean, I think if you just want an AI model, if you're a business and you just want an AI thingy that works,
Yeah.
as long as it works and it's running fine, you don't really care what chip it's on.
Yeah. But the capex commitments of the Mag 7 mean that they're going to go from a capital light to a more capital intensive model, which will
Yeah.
inevitably mean their return on capital employed will fall. And that should mean henceforth that they're less highly valued.
Yes, that's true. And the best performing companies this year, small growth companies, 41%, which is very good.
Yeah. So look at that profitable Nasdaq, and you've turned 6%. As
Yeah.
S&P 493 only 7%. So, there has been a lot of rotation
It
into
looks,
the
yeah, it looks
growth
like the people are using the wrong business model, Keith, because profitable NASDAQ 6%,
market.
unprofitable NASDAQ 21%. The
Yeah,
profitable ones need to make themselves loss making, and then their valuations will go up.
yeah, exactly. Yeah, if we too were listed on the stock market, I'd be winning.
Yes.
We'll leave it there. Right.
And are we going to have a good last few days with a Santa Claus rally?
Yeah.
Question mark.
We always do, and then it always unwinds in January, frankly.
Yeah, yeah.
Okay, and on to commodities. Thank you, Richard. So, starting off with summary, energy generally weak. Oil was continued to drift down. Nat gas also fell as European winter, as you all will be experiencing, has been incredibly mild. The only commodity was up was uranium. Hurrah for Richard. Industrial metals mixed, but generally just continuing to drift slowly higher. Precious metals unbelievable, really strong. So the return of the Fed asset buying, which is QE light, seems to have put a rocket under precious metals again. So energy, Brent down 2.9%, WTI down 3.2%, both of them down best part of 20% on the year. And natural gas futures, incredible, down 46%. Dutch natural gas futures on the year and lower even now in the depths of winter. US natural gas futures, however, crashed. Having been climbing in the last few couple of months, they fell 18% in the past couple of weeks. Still up 13.5% year to date. Coal going nowhere, down 13% on the year. Uranium drifting up again, up 6.7% on the year. So this is Brent. I think that looks like it's drifting steadily lower. And inventories are rising. I think oil is going lower next year. And Goldman Sachs are forecasting an average of 53 for WTI. So to me, that means at some stage, oil WTI goes below 50. At that point, I will be buying some, but I'm holding off. So this is data specific to the oil market, global oil inventories for November. We have that data now. Interestingly, the EIA reduced its estimate of October inventories, but it's saying that the global inventories grew by 32 million barrels over the course of November, and that's a change of 189,009 million barrels over the course of the year, i.e., inventories are rising, and that rise is accelerating. But the US inventories fell over the past couple of weeks, so the US market was undersupplied. US crude production continues to defy a falling rig count and grew once again to a new high, up 280,000 barrels on the year. We have a section on the Permian and shale coming up. Now, look at the charts on the left. This is for the IEA, who are forecasting this enormous surplus next year. And notice that they are forecasting that OPEC Plus is going to be flat. So they're going to stop increasing production next year. And all the extra supply is going to come from non-OPEC sources. Those are big projects in Guyana and Brazil, which were started many years ago and now come into production in 2026, and this is the overall supply balance. So they're saying that actually the first 2 quarters of next year are going to see big surpluses. No, so this is the OPEC plus production in the black line and the quota in the dashed line. So the quotas are going to keep on rising next year, but the IEA don't think that OPEC Plus will actually be producing more. You'll notice that the absolute numbers between this and last chart are different because this is just crude and the previous one included natural gas liquids, etc. Now, interesting, Saudi Arabia has shale, and those shale fields, its first shale fields, are coming online, but it's gas, not oil. But that still affects the oil market because the Saudi currently burns a lot of crude for power generation. And what they're doing is they're retooling their oil-fired power stations to use natural gas, and they will then export the excess crude. Thank you to Simon W. for posting that on the Discord. So when you look at Saudi Arabia's oil consumption, it consumes about 4 million barrels a day, and it has plans to reduce that by 1 million barrels by 2030. It will then export that excess. So that will add to global supplies by 1 million barrels a day. Now, OPEC Plus is forecasting demand to keep growing. That's the light blue line, but the pace of demand growth to slow. And we were talking earlier about Russia. Well, this is the measured Russian oil exports by sea, and the sanctions do seem to have had an effect. Volumes are down, and the price of Urals is down relative to Brent. So all that suggests that sanctions are having some effect. Peace in Ukraine would add barrels to an already oversupplied market if that is the case. Now, the IEA is forecasting this glut of 3.84 million barrels a day on average next year, and Goldman Sachs is forecasting WTI to average $53, so down 10% from where we are now, roughly. But Brent futures aren't really showing that. You see, Brent, you'd expect that Brent would be down, below 60 for the futures in the mid part of the 2026. Not showing that, only showing a small drop. So on Richard's point, market participants are less pessimistic about the oil price than are the investment banks and the IEA. And the trouble is, my problem is that there are loads of oil analysts out there who always think the oil price is going to the moon. And I'm deeply skeptical about them, basically. Let's wait and see what happens. So these are EU natural gas futures, down 2.8% over the past couple of weeks, down 46% on the year. Great news for UK, European consumers and for inflation. That's the UK, similar story. US natural gas prices, however, were climbing until they weren't. Big drop. Milder winter, softer demand expectations, record supply. Supply still growing. This coal going nowhere. Uranium ticking up a bit. Industrial metals, Richard.
Thank you, Keith. So, aluminium down slightly on the week, up 13% year to date. Cobalt continuing its big rise, 5.5% on the week, nearly 120% year to date. Copper has risen 34% year to date. It's been a bit of a bumpy ride, but it has had a consistent journey this year, just up 0.6% in the week. Iron ore down 1.6% and 2.4% for the year. Lithium continuing to climb up, now up nearly 27% year to date. Neodymium unchanged, but 45% year to date. Nickel down 2.5%, 5% year to date. Tin up nearly 6%. And 42% year to date, and zinc up 2.5% on the week and 5% year to date. So some quite big moves.
Yes.
And some quite small moves.
Well, cobalt is artificial. So, the government of the DRC have quotas in place to restrict exports.
Yeah.
The moment they change that, cobalt price goes to the floor.
So there's aluminium, cobalt, copper. So COMEX price is not necessarily representative of the world copper price due to tariff distortion. This is true. And it shows that the price of copper on the LME has hit new highs. There's a lot of distortion in these commodity markets everywhere, just as Keith mentioned in cobalt. the copper's going in only one direction fundamentally. Ole Hansen, the commodities guy from Saxo Bank, is he suggesting that there is some hoarding going on in COMEX?
Yeah. Now he's attributing this to fears over possible sanctions, so possible tariffs in the US. But I just wonder, as the hoarding copper, frankly, is becoming quite a rational policy, and because we know there's a looming, well, in the coming years there will be a supply deficit, and the price is rising. The thing is, hoarding would put a rocket under copper. But,
So
you know,
I just think annual production is about 30 million tons, isn't it, Keith? That's 661,000 tons. Well, it's somewhere between 20 and 30 million tons. Anyway, so that's one. That is sort of the order of a few days production.
yeah, that's true.
So actually, I would say it's irrelevant. And my problem is a lot of people come out with a lot of reasons for a lot of things all the time, and often they're wrong. And if you look at precious metals, which obviously I've been very successful in,
Yeah.
I was swimming against the tide for years, thinking to myself, why don't people get it?
Yeah.
And what am I trying to say? I'm trying to say there's you can always come up with a reason why something isn't true.
Yes.
But actually, it doesn't make that reason right. And you've got to be so careful that you don't just take one point of view, one source of information, and say, therefore, because of this, this is the truth.
Yes. No, I completely agree. No, very good point. I mean, fundamentally, this is all you need to know about copper, frankly.
Yeah.
So it will. No, the price will go up, it will go down. There'll be some volatility because there may be hoarding, and people will stop doing that, and but fundamentally, we use an absolutely enormous amount of copper every year. I mean, 22.3 million tons. Yeah, and look at the copper discoveries.
Yeah.
We just ain't finding any.
Which sort of really means what you actually want to be investing in. If you want to invest in copper, is you need to invest in miners with large, accessible reserves of a high grade.
Actually, Richard, I just slightly disagree with that because I think that the companies that will do best are the ones with really terrible and marginal mines, which are only profitable at high copper prices because they're highly geared to any rise in the copper price, and also the oil price is going down.
Well, I was just about to say, Keith, they're also highly geared to the oil price. And my view is that the oil price isn't going to go down. It might go down to 50 over the next few months, but over the next few years, it's going up. And that makes these marginal producers always a marginal producer. That's the danger of investing in producers with low grade.
No, that's true. But we're talking about now, yeah. And so, I think you have to be nimble and prepared to get out. If the oil price starts rising, then things change. Now, on the oil price, I very, very much hope it goes down below 50 because, like you, medium term, I think US shale is a finite resource. It's not an infinite resource. In the next 10 years, and we're talking 10 years, then US shale will fall. It's not just plateau, not growth will slow. Production will fall. And that has absolutely enormous implications for the oil price. So, I'm being tactical, I hope we've got a huge glut this year, which will allow me to get in at, depressed prices, and then I'm going to hold it for a long time.
So the IEA has sounded the alarm on global. This is the same IEA that does the oil forecasting, isn't it?
It is, yeah. So,
but there were people sounding the alarm with due respect to the IEA. There were people sounding the alarm on global copper supply a number of years ago, and the IEA is only just or maybe I do them a disservice. Maybe they've been doing it for a long time, but this is not a anyway. Yes, expected supply, expected demand.
Yeah. So basically, the thing about the copper market is the market always balances. So if you can't increase supply, you have to reduce demand. And that means the copper price has to rise to the point where some uses are either not done or are substituted. So,
Yeah.
plastic pipes or whatever.
And as we all know, one of the big drivers for copper demand is the electrification of the world.
Now, actually,
The
coming.
Guardian seems to be a little bit slow on the uptake. I mean,
Yeah. Well, the thing is, Richard, we also have a chart coming up on.
Milliband, isn't it?
Yeah.
It's Milliband's rag.
Yes, quite positive, possibly. But we've got a chart coming up.
Sorry, Keith, it's where he gets his up-to-date information from.
Yeah, well, I think he writes for this. It's like where the maybe the other way round, Richard. It's where the Guardian gets its information from. But sorry, we have a chart coming up on Chinese EV penetration, which is extraordinary. Yeah, they are rapidly moving to EVs, and that is another driver of demand for copper.
Yeah. And silver, dare we say it.
Yeah.
Copper is breaking out to the upside. It's interesting, isn't it? So it was it was going up, got rattled significantly by Trump's tariff pronouncements. But in fact, that uptrend, if you ignore the tariff pronouncements, the uptrend is more gentle than any of these slopes, but is well certainly in place.
Yeah, now thank you very much to Simon W for doing this. Because I obviously have been buying copper the last few weeks, but it's been doing so well, I was beginning to get a bit nervous. So I asked him about the trend, and basically he said copper's breaking out the upside, stick with it. Now but as Uncool Tom points out, this chart was done on the COMEX price, which is quite different to the LME price, but you have to choose one. And either way, fundamentally, the bottom line is the fundamentals are absolutely behind copper. I just don't see a way you can solve this. Sorry, Rich, can I do this? Now, one of the small companies, like very, very long-term viewers of Portfolio Matters, will remember that I had a position in this chemistry experiment called the Gunnison Mine in Arizona, where they were attempting to do in situ copper mining by pumping sulfuric acid down into the ore and pumping out copper sulfate. And it wasn't working because basically what they were doing was dissolving a lot of quartz. Well, they've now transitioned actually to an open pit mine, and they're the world's first users of a technique that Rio Tinto have developed, which uses bacteria to recover copper from sulfide ores. And they announced last week that they'd had the first copper from this process. And Rio Tinto claims it can recover up to 85% of the copper from sulfide ores while using 80% less water and producing 60% less carbon. So, technology continues to advance. Very good.
There's iron ore.
Yeah, going nowhere.
Lithium, going up.
Yeah, we've got loads of lithium. So, frankly, I just don't think this is sustainable.
Neodymium. Nickel, going down.
Yeah. Now, last year, nickel was defying, because we know there's this wall of nickel coming out of Indonesia. But last year, nickel had a good year. This year, gravity is taking hold.
I've got shares in a nickel miner.
Really?
On the basis that it's going to turn around at some point in the future.
Well, this week, Richard, I bought a tin miner. So after last week's episode, um, various people, including Simon W, sent me Alpha Min resources listed in Canada. I
Right.
bought some.
Good. And there's the tin chart. So Alphamin should be doing very nicely.
And it's not really, but the thing is, it produces a significant chunk of world tin, and tin, as we know, is rare in the Earth's crust. The trouble is, its mines are in the DRC. Okay, so this is not something you want to have in huge size, but
It's alpha. It's not in the. It's not in Canada or something like that. Some.
well, it's listed in Canada, but
Yeah,
its
but it's
mines are in
mines.
the DRC. So if the political situation in the DRC
Yeah,
south,
yeah,
the share price collapses.
yeah. Zinc, which is on a nice upward trend as well. Precious metals. So gold is up 3.5% on the week and 65% year to date. Silver was up 11%. Actually, it fell down very sharply at the end of on Friday, but it's actually regained most of that this morning. So anyway,
Yeah,
up 121% year to date. Platinum
unbelievable.
8.3% on the week, 100% year to date. Rhodium unchanged, but 74% on the year, and palladium up 5% and 74% on the year as well. So there's gold. Looks like it's actually now going to break out above that previous high in October.
It does, doesn't it? That looks really strong chart, frankly.
Silver has been suppressed for many decades, and the price suppression is coming to an end because there's a shortage of physical silver. Fundamentally, there's a deficit in production, which means the price suppression inevitably has to end, and that's sort of the process that we're in at the moment.
Mm.
And so it looks like it's probably going to go a lot further over the next few weeks, months, or years.
Actually, Rich, can I quickly do this?
Yeah.
So I had lunch with a friend on Friday who sent me this chart, and he had sold all his silver. He's done very well out of it, but he said that when you look at the long-term history, it has, yeah, there have been these episodes of extreme boom and bust, and he thought the risks were now to the downside. Richard, your thoughts?
Um, I don't really agree. I think as I say, the price has been suppressed by various parties who benefit from suppressing it, and that has, or at least it's been manipulated by the use of derivatives, which only
Mm.
works when there is a surplus of physical, which there is no longer a surplus of physical. As I said, there's a deficit of physical silver. So that price manipulation by the use of derivatives is coming to an end, and then silver will find its sort of natural pricing level according to supply and demand. But the point is that demand is, as I said, it's in excess of supply, and it's also going up. And in fact, over the weekend, Samsung announced that it's building a battery plant which uses silver in the lithium ion battery
Really?
for the anode. I think it's the anode, but this battery, they've solved the dendrite problem
Oh,
by using silver. And so that the anticipation is it'll be producing sort of 900 kilometers of range and fast charging in 9 or 10 minutes because dendrite's no longer a problem. I don't know the technical details. I'm sure other people know better, but that probably will add another few tens of millions of ounces of silver demand. So I think silver is only going to go up actually, and I wouldn't sell at all. I would hold on to it.
very good.
JP Morgan has gone long. I think that's all you need to know, really, isn't it? And in fact, the corollary of that is why was JP Morgan short? Because it could make a lot of
Mm.
money out of shorting it. That's the only reason JP Morgan ever does anything.
Mm.
It can no longer make money out of shorting it. It's gone long.
Yeah. Well,
There's platinum. Looks actually slightly slightly stronger chart even than gold. Rhodium, palladium.
Thank you, Richard. On to rates, which I obviously have been too long of all year. So this is the UK yield curve, and sadly, it's up on last year despite UK inflation coming down. Now, still expect that UK inflation is coming down, and that should bring the yield curve down, he says. But in the US, the yield curve is moving in the wrong direction, basically. You'll see that it's actually up over the course of the past month, despite the Fed cutting rates.
So
So,
this is where there's a dissociation, isn't there, between what the Fed wants to do and what the
yeah,
economy says, or what the market says we will pay for.
yes. And the danger for the, UK, etc., is as the long end in the US rises because they have not got their deficit under control, UK yields may not come down as much as they should do.
Yeah.
Now, the majority of US debt is now short term. So,
Yeah. I mean, sorry, can I just?
go
I'm
on.
not sure it's come down as much as they should do. It's that may not come down as much as the Bank of England and the government would like them to.
Yes, or as I would like them to, is what I meant, Richard. So the majority of US debt is now short term. So cutting interest rates actually is good for the US deficit. But the bad side of having mainly short-term debt is that it leaves you open to a funding shock if markets become concerned about the sustainability of the US deficit. Now, the market is massively short the long end. It's been that there for a while, but it's not coming down. And good news for the UK, thank you, Jaded Persimmon, for sending this, is that, the moron premium applied to UK bonds has actually come down post budget. Although, as we discussed last week, the budget actually did it really cut the deficit? It did so in like 2028.
No, it didn't.
No. Right. Okay. So next year, I haven't had time to do it, but we will revisit the whole question of whether the market is pricing in the move from RPI to CPIH. I don't think it is, but we'll do a section on it in the new year, and you'll see that the longest index-linked gilts have got a real yield of the best part of 2% and are pricing in CRPI of 3.2%, yeah, or 3.3%. Now, in February 2030, the indexation of index-linked gilts moves from RPI to CPIH. Yeah. And I actually downloaded the numbers from the ONS. So dark blue is RPI, orange CPIH. And as this table shows, on average, RPI is 0.8% per annum higher than CPIH. Now that has huge implications for index-linked gilt. If you have an index-linked gilt with a duration that's 30 years past the change in indexation, 2030, so let's say it's the 2090 bond, then the market will have to discount CPIH being 80 basis points a year lower than RPI for those 30 years. And that implies roughly a 25% fall in the price of the index linked gilt when the market gets around to it. And the flip side of that should be that conventional gilts see some flow. So there should be rotation from index linked gilts to conventional gilts. So the yield on conventional gilts falls, the yield on index linked rises. This is the 2 year. Now you'll see the 2 year has actually come down a lot over the course of this year. And spoiler alert, the UK economy ain't doing so great. So the market currently thinks interest rates in the UK will bottom about 3.5%. I can't see it. It's going to come right down. The UK economy is not doing well. I expect UK interest rates to come down to about 2.5%. This is a 10 year, sadly not going anywhere, but at least well down from its highs. 30 year, similar story. US 10 year, well, down from its highs, but the US is running a 6.1% deficit and the economy is doing okay. Difficult to see it coming down much further unless the inflation comes down further. This is the UK moron premium, which remains
Why is it called
substantial
that, Keith?
because we have a Labour government and a chancellor who used to do what?
Let's see.
We'll have to cut that bit, Richard. Actually, I was really hopeful for the Labour government when they came in,
Yeah,
but I think everyone I speak to is just disappointed.
yeah,
Um,
very disappointed.
this is Germany, really interesting. The fact that 10 years rising so much. Germany has got rid of the hard black fiscal rules and is opening the fiscal taps. Bond yields rising. France, gone.
I was going to say that Germany is I think is going into some sort of industrial depression, and it needs low interest rates, but
Yeah.
interest rates are rising, and I mean it can't get out of the industrial depression that I think it's going into until European energy prices drop back to becoming
Mm.
competitive worldwide. So they're in a real mess. But they're sort of
Yeah.
down to they do and down to they don't at this point.
Yeah. Well, more on that in a bit. But
Sorry, Keith, I keep preempting you.
oh, that's right. It's like, that you are with the data, Richard, you know. So this is the Italian 10 year. You'll notice that it's come right down because Italy is getting its fiscal house in order. So, the rising German and French bond yields are market being concerned about the fiscal deficits in those countries. This is Greece, Japan. Well, Japan going to raise interest rates this week. Market's expecting, and those 30 years just going to keep on rising. Right.
Right.
So, new section. I may be old, but this old dog can occasionally learn new tricks. And thank you particularly to Simon W., who has got this played the markets very well over the past couple of years and has taught me a lot. In particular, I have been far too concerned about valuation and not buying stocks when they hit new highs. In fact, he tends to buy them when they hit new highs. And I'm getting over slowly my concerns about valuation. So, but I'm still not going to be buying AI stocks. Now, I think the main themes at the moment are AI, monetary debasement, commodity scarcity, energy abundance, and peace in Ukraine. And we'll discuss this as we go through, Richard, because I know you are skeptical about the energy abundance argument. So AI. So Mag 7 have been rising relentlessly on hopes for profits from a transformative technology. Nvidia is assumed to have a near monopoly on chips, which I question. And AI infrastructure is propping up the entire US economy. But at the same time, investors are increasingly worried about a bubble. So AI has been the big theme of the past couple of years, but I think, as we discussed earlier, market is becoming more discerning. In particular, as Richard was saying, Google is winning. The open AI complex like Oracle are not doing so well recently. I think as we go forward, we will see more differentiation between the winners, perceived winners, and losers. But overall, the market will need to see that profits start to come through.
On monetary debasement, we've obviously had gold and silver rising relentlessly. I would say possibly for slightly different reasons. Certainly, initially, gold because of monetary debasement. Silver's been rising because of genuine shortages in demand over production, as we discussed a bit earlier. Commodities of all kinds are rising. My view is that we are entering a commodity bull market, which we will be in for many years. So Bitcoin, coming off the boil, I mean, the question with Bitcoin as well is, are people moving from Bitcoin to gold? Will they move from Bitcoin to gold? And I sort of, on the subject of Bitcoin, so I actually think that there are two elements. There's the tokenization of assets, which I think we are slowly moving in that direction. You can track your coffee from Colombia to Sainsbury's using a blockchain. I can't, but I think that's the type of thing that is being implemented so that you can track the source of the origins of things. That's not Bitcoin. That's using the technology, but it's not Bitcoin. And Bitcoin as a store of value, incredibly volatile. It's expensive to spend, and as Keith points out, it's useful if you're a criminal. I just think Bitcoin probably, I suspect its day is done, but I may be completely wrong. Bonds, I wouldn't touch with barge pole, just because I think that we are in such an inflationary environment. Governments have to issue so much debt. There's going to be yield curve control. But I think the whole thing is a mess, and I would steer clear of that completely. And then with the Japanese yen and the rising Japanese bond yields is that the carry trade is over, isn't it? So the borrowing of a large sums of money in Japan at very low interest rates and then investing in US assets for the sake of argument and getting a return on it, those days are coming to an end, or have come to an end even. So that means there's big investment flows washing around the world as those carry trade investments are terminated. So there's I actually don't really know what the fallout from that is going to be. You may have a view, Keith.
Well, no, I don't know what the fallout from Japan is going to be, but Japanese bond yields are going to have to normalize to the rest of the world so that yields keep on rising. And that, you would then think that Japanese investors might start repatriating capital, which would be bad for global bond markets. But at the same time, the yen's keeps on falling. So will they do that? Not sure. Let's just wait and see what happens.
Yeah.
I'm obviously more positive on bonds because bonds are, now offer you a real yield, and the UK is not going to default. And the reality for UK investors is that you can get best part of 2% real, pretty much tax free by buying long dated bonds. And so,
yeah, it depends on your investment objectives, doesn't it,
yeah,
Keith? I mean, if basically you want to put your cash somewhere sort of safe and you're happy with a small relative yield, a small real yield, then that's completely fine. But if you want to get a chunkier return,
yeah, which we all do,
which I do. Bonds is not the place unless you're parking it in short-term bonds for a short period of time.
Carry on.
So then we have commodity scarcity, which we've discussed. Copper, tin. I don't know very much about tin actually. It's not been on my list. Obviously, Keith knows more about that. And uranium, which obviously with the development of small modular nuclear reactors and the extension of the lifespan of existing nuclear power stations and the building of new nuclear power stations, all putting a strain on the supply of enriched uranium.
Yes. So any more, Richard? These are the three that came to mind for me where there's actual scarcity.
Not really. I think those are the ones that I'm aware of, Keith.
Yeah, on tin, as we've discussed, is very rare in the Earth's crust. And the environmental regulations which get rid of lead in solder means that you have to put more tin in solder, which means as we increasingly use electronics, the electronics demand just keeps on going up, tin demand keeps on going up, and we aren't printing more of it. So,
Yeah.
bullish tin.
So energy abundance. There is Keith and I differ on this in the sense that I suspect that the forecasts are wrong. But there may be a glut in beginning of 2026, but I suspect that it's not going to persist. And
Well, hang on. When we say we disagree, we agree medium term.
yeah,
We agree medium term. It's just a short term outlook. And yeah, fingers crossed. I really, really hope there's a glut.
yeah. You beat me to it, Keith. I was just about to say that, so well done. Exactly. So I'm thinking shorter term, this is going to manifest itself, and therefore I have purchased oil companies already in preparation of that. And I have to say, I've sort of developed my modus operandi over the last few years, where I was early with precious metals. I was very early with precious metals, and it was quite painful at times. But I stuck to my guns because I was convinced of my thesis. And I may be early in oil, but I know what it's like, if you see what I
Yeah.
mean.
Well, I mean, frankly, I've always historically I've made my money from oil, and I've always tended to be early. But this time I'm waiting. I think
Yeah,
it's going to go lower. And the thing about the oil price is it's very volatile because there's limited storage capacity.
yeah.
So, I expect it to go WTI to go below 50 in 2026, and then I'm going to start putting it on in size. Now, I've already bought a little bit, and I've got a few, limit orders at low levels for
So
others.
that's interesting. So I have read a couple of articles, well written articles by clever people, um, whose thesis is that uh, there is a shortage of there will be a shortage of oil because production difficulties basically and increasing demand. And I, it seems very rational and realistic. So, as I said, I'm no good at timing, and therefore I've decided that I'll make my investments now. A lot of the companies I've invested in are pretty low levels, and I will just have to ride out any drop in the oil
Yeah.
market.
Well, the thing is, Richard, people have always been talking about peak oil. You know, Twilight in the Desert, which I read, came out in what, 2005, talking about how, the Saudi, etc., they were in terminal decline. Well, they weren't.
No.
Everyone's always too optimistic about the oil price. But to me, as we talked about in the oil special, the decline in US shale, we'll more on this later, but you're halfway through the geology. And when that's added 13 million barrels. That's like 9 million, sorry, 9 million barrels. It's added 9 million barrels. If you take that out, and that's coming out in the next 15 years,
Yeah,
oil goes to the moon.
yeah. That's a lot of what these people are saying, Keith, and it's just a question of timing. And I think their view is the decline rate is actually significantly higher than
Right.
uh, people believe it. Generally. So
Yeah,
the
but
last point,
on that point, Richard, over the course of the last 4 years, I have covered quite a few people who are saying that shale is in terminal decline. There's Goering and Rosenzweig, and then Art Berman, all saying that the decline rates were much faster, etc. And then, as we covered this week, US shale keeps on hitting new highs.
yeah,
So I'd be very wary about these people.
yeah, no, yeah, I mean, you're right, Keith. So peace in Ukraine, bad for the oil price, good for the world economy, definitely good for Ukraine, really.
Yeah.
Um, and good for equities with Ukrainian exposure. I'm sure that's true. I don't know these companies.
Right. Okay. So quickly, I bought some for Expo this morning. Okay, it's actually up today, so it's about 77p last time I looked. But it's a big iron ore mine in Western Ukraine. It's the third largest iron ore pellet exporter in the world, and Share price is not going to go back to its highs of period, but double, treble from here when they get production is very badly disrupted at the moment. Now, MHPC is Ukraine's largest producer and exporter of chicken, and it is listed in the UK, but it's listed as a GDR and very illiquid. But if you want exposure to Ukraine, that could be an option. And the only other company that ChatGPT was suggesting with Western listed and exposure to Ukraine is Vion, which is listed on the Nasdaq. It owns Kyivstar in Ukraine. It's not a pure play Ukraine company, but it has assets there. Okay, thank you, Richard. Now, on that section, we will be not going into it in as much depth on a weekly basis, but we will be updating it, whenever we have new ideas or old ideas fade. If you have any suggestions, please send them in and we will discuss them. On to this week's economic data. Quick summary. UK, no change really. Stagflation turning to stagnation. Inflation should be coming down. EU, stagnation, but stable stagnation. US, fine. Is the labour market actually bottoming out? Question mark. China, economy may be weakening. Certainly, you've got no inflation there. Right, UK, Richard.
Thanks, Keith. So UK GDP month on month, 0.1% fall in October year on year. Well, I think that's within error of so the UK is not growing basically.
Yeah, I agree.
Industrial production up 1.1% in October. It was down 2% in September, wasn't it? A year on year down 0.8%. That's not good. UK is not growing. Construction output 0.9% year on year in October.
That's not good,
Especially when we're building so many houses, or not.
Or not. No, I mean, this is not good. I mean, it just seems like all the engines of growth in the economy are stuttering.
Yeah. UK construction PMI 39 in November, which has fallen from October's and is on a bit of a steep path down.
Yeah. So when we look at the output, that is past. This is present/future and not encouraging. That's a 3-year low. What it's saying is the UK construction sector is in recession.
Yeah. House prices month on month unchanged in November. Not surprising because nobody was doing anything, waiting for Rachel to give us her views on how to make the UK economy more functional. House prices year on year up 0.7%. UK balance of trade in October was only negative 4.8 billion. As the economics price index, make of that as you wish to.
Yeah, but it's not good.
Indeed, job postings actually starting to move upwards.
Yeah, this is really interesting.
Mm-hmm. And trueflation 1.4%.
Yeah, usual caveat supply, but let's hope the trend is correct.
Yeah. And as you will all know, the UK raises minimum wage to over 60% of the median wage. And the only other country with a similar level is France, where it's like the whole thing is just completely out of whack, if you ask me, completely.
Yeah.
So not much data, very discouraging. Everybody's very fed up. We're all being taxed more. We're not seeing any more for the tax that we're paying. Anything that any industry sector that shows any degree of profitability is having the lifeblood bled out of it by Rachel. And we are on a depressingly downhill path.
Yeah, frankly, from the data, there's just no cause for optimism.
No.
But
what strikes me is that this government looks to see where the economy is doing well and taxes it.
Yes, that's a very
No,
good point, mate.
it's like
Well,
so stupid.
in which case they've got nothing to tax.
It's just so
Um,
stupid.
so, but that means, to my mind, it's like UK economy is not doing well, and that means inflation is going to come down and interest rates are going to come down. That's the because the only two basically we are stuck now with fiscal tightening over the next 3 years, 4 years, and we have to do that to reassure the bond market. The danger is that if the economy slows, wage growth slows, and Rachel will miss her targets because tax revenues will slow and also unemployment will rise, which would mean she'd have to raise taxes again. So, if as we've got fiscal tightening, the only two ways to stimulate the economy are lower interest rates, lower exchange rate. I expect both to happen. So, if you're holding gold in sterling terms, let alone in dollar terms, it's going to go up. Right, quickly onto the EU. Not much data generally this week. So we had employment change for Q3, and that was good, better than expected, up 0.2%, 0.6% year on year. So we know that we know that EU unemployment has is close to its all-time lows. That's all good. GDP change in Q3 was resilient, up 0.3%, up 1.4% year on year. So, growth in the Eurozone is back to pre-pandemic norms, i.e. anemic, but stable. Retail sales, 0% month on month.
Just, I got to say, there's an article in the FT last week. It was written by some Europhile researcher. I think she was based in the US, and it was talking about how Europe can become ascendant in AI technology. And
Yeah.
she's clearly linked in, keyed into the EU at a high level and so forth. And she was saying the EU will beat the US at AI technology because the US is going to fail.
Mm,
That's
right.
her thesis. So Europe's going to win because the other side's going to fail.
Yeah. Well, my probability of that is zero.
It was
Frankly.
utterly, utterly wishful thinking.
Yes, no. It's like if we start to win, that they'll stick some regulations on it.
It
And
was it was pathetic. It was truly pathetic.
construction PMI still in recession, bit less than in recession. Economic surprise index positive still, so outperforming low expectations. Now this is interesting. So Germany, like the UK, but labour market appears to be bottoming out, not growing, but not fading anymore. France, not sure you can say the same, frankly. Still downward trend intact.
Mm.
Europe has had a declining demographics for a long time now, and it is going to start biting quite soon. So Germany will see a falling working age population. Now, how will then it maintain GDP growth and, you know, pay its debts, etc.? A lot of Western Europe is going to be facing this sort of scenario.
So the answer, Keith, is Europe's AI robotics dominance.
Yeah. It's science fiction novels. Um, and when we talk about the EU economy, this is European car exports both to the US, subject of tariffs and have fallen sharply, and China, where China have done what they always do, invited European manufacturers in, copied their technology, made it better, and then they're taking over European markets all around the world. Not great. And on Richard's point about Germany deindustrializing, this is the number of insolvencies. Oh dear. So the thing is, you remember years ago, but over the past few years, people were talking about the UK economy and how, there's no longer had manufacturing. Well, everybody's now China is taking over the manufacturing a function of the entire world, basically. And so not being in manufacturing is suddenly looking cleverer.
Having been knocked out of it first.
Yes, well, exactly. So here's the summary. Basically, bottom line is stagnation, but quite stable stagnation, no sign of recession. However, medium term, the fundamental imbalances in the Eurozone are still in place. France runs a huge deficit, and there's no way, I can't see a way of solving that. So
No.
at some stage, everyone assumes the Eurozone will last forever. We don't assume that. US, Richard.
US interest rates, so falling, as we know, Jay Powell having reduced interest rates to 3.75% in December, quarter point reduction. Three dissensions. Is that right?
Yeah.
Yeah.
Yeah, so two wanted no change, and then, Trump's appointee wanted a 50 basis point cut, as he would.
US inflation month, PC inflation month on month 0.3% and year on year 2.8% as for September. So just a
Mm.
little bit of an uptick there.
But not coming back towards target. And the Fed is cutting rates.
Yeah. And core PCE inflation month on month 0.2% and 2.8% again for September.
Now, that is good news, though.
So the elevated US inflation is a function of goods prices, and then that imputed housing inflation is continuing to fall out of the numbers. So basically, housing dropping, goods are quite high.
Yeah, no, the imputed numbers, Richard, is because they've fired a load of people from the BLS and they're not actually sampling the data anymore. So they're having to kind of,
Oh, is that right?
yeah, they've got computer models like trying to work out what all that missing data actually would be.
You could set up an AI model, couldn't you, where it does phantom supermarket shopping
Yeah, that's probably what they're doing.
and it junks the basket and the supermarkets get peed off. So Goldman Sachs have estimated that tariffs have boosted core PC inflation by half a percentage point. Maybe so.
Yeah, but look at the forecast. They're saying that it's going to rise in the next few months
Mm.
and
But
then
it's
close.
not the sort of dire scenarios that everybody was shouting around about
Yeah,
in January and February, is it? And
no.
March. The world is doomed, sort of thing.
Mm.
I always feel this sort of stuff. There's an awful lot of noise gets produced. A lot of people run around like headless chickens, shouting about how dreadful everything is, and it all settles down, and nothing changes.
Yeah.
It's very important to try and sift out the really significant things from the
Mm.
day to day discussion points, shall we call it. Goldman Sachs forecasting PC inflation will be 3% at the end of 2025, possibly 2.2% at the end of 2026. Possibly, they may be right.
Yeah. In which case, interest rates coming down more than the market expects.
Maybe. I mean, maybe, or maybe not.
Maybe. Yeah.
Um, September super core is 3.26, above the Fed's target. So, yeah.
Yeah. I honestly, I think the Fed don't see why the Fed should cut rates. You know,
No, but they probably will, won't they? Because of the political pressure. In some senses, it's like if you invest in to my view is if you're actually investing in commodities for a long term commodity cycle, it doesn't really matter what happens to interest rates
yeah, true.
or
Yeah,
inflation.
the trouble is, Richard, that historically I've played the cycle and I've totally messed this cycle up. Actually,
Yeah,
the cycle didn't turn down, and so interest rates were important to me. But
yeah,
I'm rapidly coming to the realization I've just got this wrong, and it's time to change strategy. So,
yeah,
hence, I'm tilting away from
yeah.
bonds. But at some stage there will be a recession, and at some stage bonds will do well. But right now, honestly, I can't see it. So,
Mm. Uh,
I bought some copper,
yeah,
tin.
and I agree with you, Keith. I mean,
Yeah.
at some stage, probably will be a recession. Interest rates may drop, but it's sort of like it's peripheral to my investment thesis, I suppose.
Yeah. Well, you've done incredibly well.
Thanks. So US rents remained in deflation in November. Got quite a lot of deflation to go before they come back to what they were. Goldman Sachs core inflation tracker is stable at 2.2%.
Yeah. So, that's encouraging.
And interest rates, as we know, are becoming less restrictive.
Yeah.
US JOLTS opening 7.6 million, a little bit above expectations, but nothing remarkable, I'd say.
Well, the thing is, Richard, that, when you look at the absolute level, yeah, that's all right.
Yeah.
You know,
Yeah. It's back to where it was pre-COVID.
And it is not fading.
And the quits rate is down, but I don't, it's been coming down all the way from 2022. It's sort of slight, if you go back to 2016, it's about at 2016's level. So
yeah, that's true. But I think it does suggest that Americans are feeling less secure in their jobs. Unsurprisingly, I mean, because, when the US government's firing a load of people, it's not going to make you feel more secure.
And jobs layoff data is marching higher. But again, it's coming back up to what was trend for most of the 2000s.
Yes, exactly. It's marching up, as I said, it's marching up towards normal.
Yeah. And the jobs hiring is weak, and it's probably below the sort of long-term trend if you just cut the COVID spike out, a little bit below the long-term trend. And private sources suggesting that the US is continuing to create jobs in October and November, which is interesting.
Yeah. So, well, the Fed's cut rates, but when we look through the labor market data, it seems to me that the labor market is stabilizing.
And the ADP numbers not terribly encouraging. So we had this is fairly short term, but obviously since 12 months ago, basically it had been a continuous decline. It's now just gone slightly negative. And the labour market is close to equilibrium, according to this chart. So
yeah, but when you look at it, what the average has been over the last 40 years, generally there's been higher unemployment.
Yeah.
So
sort of minus 1% or something. Looks like it's probably around about the average level.
Yeah. So the labour market is actually quite tight.
Yeah.
Looks at it compared to the average.
Yeah. So the American Staffing Association is reporting that temporary hiring has returned back to growth after declining for a couple of years. So that's a good sign.
That is a good sign. But I had a look at temporary help services. And I couldn't see it. So this is the data from the St. Louis Fed, and it says number of temporary help services employment continues to decline, although the rate of decline is fading. So less positive. But again, suggests that actually the labour market is sort of stabilizing.
Yeah. US personal income month on month, 0.4% up in September. And spending 0.3% in September. Pretty normal there.
Yep.
ADP employment change, a little bit negative in November, but nothing dreadful, I would suggest. US Challenger job cuts falling back down, actually. Employment cost index up 0.8%, so that's still on its downward trend from 2022.
Yeah, with a US productivity growth that is perfectly compatible with 2% target.
And Michigan consumer confidence at 55. It's the bottom end of its range, but
not great.
Consumer expectations 55, so moving up a little bit. 1 year inflation expectations of 4.1%, which is falling actually.
Yes, that's good news.
5 year, they're also falling 3.2%. And The New York Fed consumer inflation expectations 3.2%, same as last month. Business optimism at 99, which is a decently high level. Balance of trade, sort of average, really.
Well, actually, you'd suggest that tariffs are having some effect.
So if you go back to pre-COVID, it's sort of slightly on the high of average, but more recently it's dropping back down, isn't it? You have to discount that big spike down, don't you? That was a pre-tariff tariff sort of holding.
Yeah.
So yeah, initial jobless claims spiked up 236,000. Not very different to expected though. Continuing jobless claims spiked down 1.
Yeah, this is extraordinary.
Yeah,
that's a big drop.
And warn notices are a little bit on the high side still, but not. They haven't spiked up to that early 2025 level yet.
No.
Indeed, job postings possibly leveling off. Looks a bit German. No, a bit French, doesn't it?
Well, yeah, it's not quite clear, but
And link up job postings are falling again.
Yeah, that's contradicts the LinkedIn numbers. That shows continued deterioration.
So Dallas economic GDP estimate weekly 2.3%. Atlanta Fed 3.6%. Yeah, New York is at 1.8%.
Yeah, they've all come down a little bit, but that's just fine. The UK would kill for these numbers.
Yeah. And the St. Louis Fed 0.4%. But the St. Louis Fed, I think, is always low, isn't it?
It is always low, yeah.
There's the Economic Surprise Index. True inflation 2.7%. Definitely climbing.
Yeah, that is not good.
And manufacturing. US manufacturing investment is currently falling.
Yes. So tariffs have not succeeded in boosting US manufacturing investment.
And heavy truck sales are falling sharply, which can be a harbinger of recession.
Yes, it doesn't have to be, but it's certainly not a good sign. It suggests that construction activity, which is mainly what this is, is falling. This is the first 2 months of the 2026 fiscal year. And all you need to know is that the US government spent 1.2 billion and it's got 740 billion in tax revenues. So it is spending, what's that?
Oh, right.
More than 50% more than it's taking in. That's shocking. Totally, totally unsustainable.
They'll have to increase the tariffs, Keith.
Oh, well, they will, mate.
Put it on copper. That would sort it out. Oh, this looks like a chart of silver.
Yeah. Well, you should have bought a tin of tomato soup back in 1970, Richard. It would have held its value to, actually gone up 14-fold. You heard it here first. Buy an
old tomato soup.
Tomato soup.
This is your new investment thesis, Keith.
Yeah, well.
There we are. So this is just a chart of fiat currency, federal debt, etc., etc.
Well, this is I think this is an incredibly important chart. Okay, because we take the period, the sort of the monetary settlement that we're currently in for granted. But it's actually only started in the early 70s. And prior to that, the amount of debt you could issue in a fiat currency was limited because, fiat currency was linked to gold. You couldn't just continually devalue your currency and print more money. Yeah. But since 71, when Nixon took the US off the gold standard and we moved to a pure fiat system, the amount of debt has absolutely exploded. Now, Richard's debasement theory is predicated on this, that essentially this debt levels just look totally unsustainable. And, we take the current monetary system for granted. Will it end in a huge debt bust, which leads to a new monetary system and a reinstigation of some sort of gold standard, which limits the amount of debt that countries can issue.
Yeah, basically, it removed any obstacle that politicians might have faced to issuing vast quantities of debt to appease the electorate, and which
Yeah.
they've continued to do since then. It has to change, doesn't it? I mean, I don't know what it's going to change to, but it is unsustainable. It could probably be sustained for quite a lot longer, as in 5 years, 10 years, 50, who knows? But ultimately, it has to change.
Yeah, you can't keep on issuing this amount of debt forever.
And in order to stabilize it, it has to be registered against something
Mm,
that is stable, and that is not Bitcoin, by the way.
yeah. Actually, on that point, when I did my master's in economics history, we looked at the first fiat currencies, which were Chinese paper currencies.
Right.
It will appeal to all your prejudices, Richard, that these always ended in a huge inflationary bust. Okay, and so they'd issue a currency, they would then start printing more of it, and then they would end up defaults like getting rid of that currency, and every method they tried to limit the amount of money in issue always failed. So they'd issue a new one saying, well, we've limited this one strictly to X.
Yeah.
But actually, when the time came and they needed more money for the
Yeah.
Chinese, yeah,
X became 2x,
yes, exactly. They
and then
needed to,
4x, and then 8x.
yeah. And the thing is, because in those days, obviously the information transmission mechanism was much more
Yeah.
basic, you could get away with it for a while,
Yeah.
until people saw prices rising and then would realize actually, despite what they're saying, they're printing more money. So,
Yeah. It's so bottom line, US economy is doing okay. AI infrastructure spending is obviously making a big contribution to that. The government's running a 6.1% deficit, and it's hard to see a recession coming along whilst all of this remains true.
yes. Okay, on to China quickly. Um, so China is in deflation once again in November, and inflation is only 0.7%. Producer price inflation remains firmly negative, so demand there's an excess of supply of demand. Exports 5.7% year on year in November, better than expectations. Imports weaker than expectations. Loan growth weaker than hoped. Social financing um, high, so the Chinese government is stepping in once again with fiscal stimulus. Loan growth fading. This is all you need to know about the Chinese economy. Loan demand is fading, so growth should be fading. Balance of trade, enormous. So China continues to run an export model. It's basically exporting, it's getting demand from outside the country. And I didn't realize this. So China's fiscal deficit is actually really bad. It's worse than the US's. And despite that, inflation is zero. So it suggests there is fundamental lack of demand in the Chinese economy. Now, I thought this is a really good chart. So China has very low domestic oil resources, and it is trying to reduce its dependency on foreign oil and encouraging this move to EVs. And the move to EVs has got really strong penetration. So you're almost approaching 40% now. So on the current trajectory, you're going to be hitting 50% by mid 2027 and fully transition essentially pretty much over the next 10 years. Now, that is negative for oil demand growth and really positive for copper.
Yeah, it's true.
Now, so this is the gasoline consumption of China with what's actually happened, dark blue, and what would have happened without electric vehicles. And so it's already having an effect on gasoline demand. But of course, China doesn't just consume gasoline, also consume diesel, aviation fuel, oil for petrochemicals, etc., etc. Now, if those forecasts for EV penetration are true, then Chinese demand for gasoline will peak relatively soon and then start to decline. But when you look at total oil demand, then it's going to keep on rising. You are here for the next few years, and then starting in the 2030s, perhaps start to decline. Bottom line, Chinese economy is weak, but very difficult to know. It's still, still operating this export model where it's running a huge surplus. Okay, and on to one chart. So this is global loan demand. So that's Eurozone, US, Japan, UK, Korea. GDP weighted. Essentially, as interest rates come down, loan demand is rising, and that should support the world economy. So early next year, I'm going to do a huge section on copper, but we're not there yet. On to stock market valuations and future returns. Richard.
Thanks, Keith. So I think we've shown this chart before, haven't we? Which is basically history shows a little relationship between the stock market valuation and 1 year returns, unlike the 12-year return that we looked at earlier.
Yeah. But this chart, which is for the 10-year, shows that there is a relationship between PE ratios and 10-year future returns. The higher the PE ratio, the lower the future returns. And that relationship is quite strong with an R squared of 69. It's 0.69. So that means that 69% of the variance on future returns can be explained by the P ratio at the start.
As we discussed a little bit earlier, this relationship seems to have broken down over the last few years. And as we have also discussed, this is probably due to the vast amounts of money printing, QE, and so forth that's been going on that has disrupted previous correlations.
Essentially, the market's just performed much better than a simple yield model would have expected, and all the, as a valuation model would have predicted. So, everything history suggests that this is mean reverting over a time period. So whenever it gets really out of whack, eventually it will come back down. Now, I still expect that to be true, but if we are entering a period of, Richard's right about monetary debasement, etc., etc., it might well not be. So, the question is history a guide to the future?
And over the very long term, starting valuation is much less correlated to future returns, which makes sense, doesn't it? Because over a very long period of time, businesses change their model, they change their products, they do all sorts of things over a long period of time.
Yeah. But also, because the stock market just keeps on going, keeps on rising, your entry point, becomes less relevant after 25 years.
That's right. Products evolve, technology it changes. So long-term returns are a function of earnings and dividends, as we know, compounding over time. The stock market is overvalued compared to history if you look at it in terms of fiat currency.
Yeah.
The issue that we've got is fiat currency is being significantly debased. So a lot of things are highly valued. And this is one of my problems, becoming more of a problem for me now, is that the benchmark that we're using, aka the dollar, is unstable.
Yes.
So we're measuring a lot of things against an unstable base.
Yeah.
And maybe that's one of the reasons there is no relationship between valuation now and returns over the coming year. Sorry, that's not right. Ignore that bit. But that's the fundamentally. I think this is showing that the debasement is starting to really matter.
Mm. Well, it certainly is for precious metals. God. Okay, and thank you, Richard. So on to oil. Now, we did a special earlier last month about um, the oil market in general. And as we were discussing earlier, the long-term outlook for oil depends very much on what happens to US shale output. Now, the biggest shale basin is the Permian. So what's going on in the Permian? Now, so we talked earlier about how the IEA is forecasting there'll be an oil glut of 3.86 million barrels a day on average in 2026, but the oil bulls think that's wrong. Their narrative is, and have a read, that tier one shale oil acreage is largely drilled out, that gas to oil ratios are exploding. And if you've watched our special on oil, you'll see that is actually the case. They're not exploding, but they're certainly rising. Water cuts are rising, also true, and decline rates are accelerating, also true. But what is the net effect of that, and what is the evidence from the Permian, which is by far the largest US shale play? So the rig count has been falling. So that is basically the solid lines. The frac count is down. And when you look at drilling efficiency, so that is the amount of lateral feet drilled per rig. Well, the growth has been rather slow. So when you took loads of rigs out of the market during the pandemic, when the oil price collapsed, you left only the best crews in a job, and so you got this big surge in efficiency, which then faded as the rig count rose again. And then you've had a steady rise, but overall, the growth of the past 4 years has not been huge. But overall, crews are still getting better at drilling further per rig per month. And they're also using more proppant. So more proppant means keeping the cracks open for longer and better production. Also, we know that there are now fewer drilling rigs in operation, and that means, although the drilling crews are getting better at drilling further feet per rig, um, overall, the total impact is down. And it's expected that in the Midland Basin, you're going to have drops around 20, actually, in both basins, you'll have drops of total lateral feet drilled of around 20% in 2025. So the amount of laterals drilled has been in decline. And when you look at frac crews, then you get a similar story. The amount of laterals flat fracked means that you expect to see around 15% drop in oil production. So now looking at the amount of inventory, so the total number of wells that could possibly be drilled and how many have actually been drilled. Now, this is really important. So Novi Labs estimates in the Midland around 16,000 wells have already been drilled. Around 8,000 have been drilled in tier one. Yeah. But there's a lot left. Yeah. So we are approaching halfway. We are not past peak. So there are 10,000 more drilling locations in tier one and also 10,000 further in tier two. 25,000 in lower tier rock. Now, when we go back and look at how many have been drilled, You're approaching halfway in the tier one and two, not in the tiers two and three. But having said that, um, when you look at the most popular locations, Wolfcamp A and B, over 60% of tier one locations have been drilled. So, you can tell a story that, you're past peak if you look at just the Wolfcamp A and B. But when you look at the play as a whole in the Midland, you're not. So the Delaware was developed later than Midland, and when operators had discovered how to identify the best rock, and as a result, they have been drilling mainly tier one. But again, there's still a lot left. They've drilled roughly 11,000, but there are still around 16,000 tier one to go. You're not approaching halfway. The ratios are even better for the lower quality locations. So all that means that tier one, less than 50% drilled, and the ratios elsewhere are even lower. There's a lot left to drill. But once again, the largest location, Wolfcamp A, you are getting 50%. So if you want to tell a story that Permian's in decline, and you concentrate on particular areas, you can say that. But overall, if you believe Novi Labs, who have done a lot of work on, the whole Permian Basin, then the Permian as a whole is not at peak. It's approaching the halfway stage. But because the Permian is being approaching halfway, and you put in a lot of wells, those wells start to interfere. The cracks you do on one well will extend to the next one, and that means that when you try and frack your next well, you will find some of the pressure leaking out into the cracks which have been put in by the previous wells. So that means you can't get the pressure up as high, and that means you can't frack as effectively. And so, Novi Labs have estimated the effect of prior pressure depletion on future wells. And you'll see, although many of them are not affected, actually some of them are very badly affected, 40% or more. So that will have an effect on future wells. But overall, looking at the inventory life, tier one, you've got another 10 years in both. But I would say, as you start to approach the end of your tier one inventory, you're going to slow down the drilling there. So how many more years of peak drilling have you got? 5 at most? Ignoring rock quality, how many years can US companies keep drilling in the Midland? Answer 15, even longer in the Delaware. And Novi Labs have applied a 25% discount rate, so NPV 25. And so at that discount rate, how many drilling locations in the Permian are financially viable? Answer, a hell of a lot. 5,500 drilled in 2023. So if you look at, say, 100,000 wells, your break-even price is, what's that? $70. So basically between 50 and 70, actually 60, late 60s. So between 50 and late 60s, a lot of wells become economic. But reminder, shale wells decline very quickly, about 40% per annum. So you need to do a lot of drilling just to keep production going. The moment drilling slows, production will start to decline. So how much more can the Permian grow? Probably, not much is the bottom line. However, as we've said many times, the shale production is a technological revolution, and innovations continue. Now, this nasty stuff here is petroleum coke. Petroleum coke is just a byproduct of the petrol refining process. It's pretty useless, frankly, but they've now found you can grind it up and use it essentially as fracking sand. So, because it's light, it travels with the fracking fluid, fracking water, right into the smallest cracks. The heavier sand tends to stay close to the fracking site. So then what you're doing is you're keeping the the fracking cracks open deeper. And Exxon, who are doing this, claim that they can increase recovery rates by up to 15%. Now, 15% is huge. 15% on, say, 9 million barrels a day. You're talking about adding an extra million barrels a day. That's a big increase. And, innovation just keeps on rising. So if they can keep on innovating, then perhaps they can continue to grow Permian production and keep production at these levels for longer. So this is new technology, and Exxon intending to apply it to 200 wells this year. So this will have a future impact on Permian production. The other thing they're doing is they're using biosurfactants or surfactants to reduce the friction between the oil and the rock, increasing flow rates and recovery rates. And they are claiming that you can get much more oil out by adding these biosurfactants to the fracking fluid. However, I would say that this is quite old. This was first talked about in 2020. This chart is from 2022. So it's probably been used on all wells for a while now. But according to ChatGPT, surfactants can boost production by up to 20%. But I think this is probably already in the production numbers. The pet coke probably isn't. That's new technology and will be rolled out. So, positives for future Permian production. Over half the resource remains. The majority of wells are profitable below $60, and new technology in the form of surfactants to increase oil flow rates by reducing friction with the rock and lightweight proppants could increase recovery rates. So all that's good for production, but at the same time, well interference is an increasing problem. Productivity per lateral feet is in decline, as we talked about in the oil special, and the amount of lateral feet drilled is in decline with the rig count, because the rig count is down. So in around 10 years' time, the Permian will have almost totally exhausted the tier 1 drilling sites. And you need to keep on drilling and putting in new wells because the depletion rates are so high. Now, HFI Research are forecasting that US oil production will be broadly stable over the coming year. So I'd be interested in Richard's thoughts at the end of that. But to me, it seems that the geology will increasingly start to work against the shale industry over the next 10 years. But this is not an immediate story. This is, right now, there's still plenty of drilling sites left. Technology is improving. And, if the oil price went high enough, you could get increased production from the Permian. But the geology, within 10 years, the Permian will be in quite big decline. Richard, your thoughts? You're on mute.
That's interesting, Keith. Thanks for doing that. I mean, you know a lot more about the subject than I do, and and clearly it seems that it's a stable source turning to a declining source, effectively, doesn't it? Over, as you say, the next 10 years. I think it's one of the factors in oil production. Oil demand, I expect, is going to increase. Um, and of course, there are many other fields that are also going to be in decline, as well as new fields coming on. So, I my view generally is that the oil price is going to go up over the next few years, as we've discussed.
Mm.
That now is not a bad time to start putting some money into it in anticipation of that, but that may be a period of time where there is no or negative return on those investments. And
Yeah.
that's the way I'm playing it. Um, I think what would persuade me to not be in oil or oil services actually would be that if there were something were to change and there were clearly massive, significant surpluses going into the future. But
Mm.
you
Well,
know,
the thing is, Richard, I just don't think there can be huge surpluses going into the future because, the oil market has always been boom and bust. So when the oil price collapses, nobody invests. 5 years down the line, there are no new wells.
yeah, yeah, that's very true. And various forecasts that world oil consumption will move up to maybe 130 to 150 million barrels a day as maximum consumption over the next 30 years. 30 years is a long time frame, but the trend is upwards.
Yeah, I just don't think that can happen. There's not enough oil. It's just like,
Yeah,
we are, you know, in order to, the new wells are in regions we haven't previously explored, like Gaia, offshore Guyana, and they're in deeper and deeper water. I
yeah,
mean, so, we're having to, once we've kind of, with all this latest round of of wells that were, explored and put into construction 10 years ago, once they start like coming online, then I don't see a huge new round coming on.
yeah. And then that pressure of demand is obviously going to
Yeah,
push the price up.
absolutely. So, not an investment for the immediate term, but medium term, 5 to 10 years. I think oil goes to the moon if shale actually goes into decline, and I think it has to.
Yeah,
So, very quickly, because you all know this, but like the on AI, so Google launched Gemini 3, which is the latest model which was trained using their TPUs, which were proprietary, developed themselves, not NVIDIA chips, and going through these quickly, the results are great. So it now beats ChatGPT on most of, or pretty much everything, basically. Humanity's last exam, Gemini 3 Deep Think, 41%, much better than ChatGPT at 30%, etc., etc. Big advance on previous models. 95% on a very hard maths test, matching ChatGPT, both of them basically scoring 100% with tools. This is interesting. On a set of 12 hard problems, maths problems, which was specifically set to challenge state-of-the-art models. Look at this. Gemini 3, 24%. ChatGPT, not much.
mm.
Big leaps forward. Not as good as Claude Sonnet at bug fixing, better at writing complex code, um, much better at solving real world problems, actually. This is a business simulation of running a vending machine company. So ChatGPT is in orange, Gemini is in blue. And as Richard was saying earlier, the market is deciding that Google's going to be the winner. So, and also, Google is now offering its TPUs to other companies, which should be bad or could be bad for Nvidia. So, bottom line is that, you know, OpenAI, which has got these ludicrous revenue and growth forecasts, Well, it's a crowded marketplace. I can't see it. And frankly, the market is also becoming more skeptical. So, and also Nvidia's monopoly is under threat. So, again, all those growth forecasts for Nvidia, you know, at some stage, will Nvidia's growth come down to earth with its revenues as more competitors join the market? Okay, and quickly onto ChatGPT, because the other thing that's happening is that although ChatGPT is by far and away the most used AI tool, Gemini 3 is cutting into its lead and its user growth has actually stalled. Now, this is from October, but when you look at the data for November, it's not growing. So all those like user growth numbers that's going goes to the moon. 40% of humanity, as we talked about last time, end up using ChatGPT. Well, user growth actually slowing, market share ticking down as Gemini takes market share, and the amount of time people spent who use GPT actually use it appears to have peaked and to have peaked actually quite a long time ago. And this is the latest data, which includes the post Gemini 3 launch, and that shows actual declines in ChatGPT web traffic. So no longer not, the growth is not just growth is slowing, actual declines. And misfinally, a lot of people who use AI use it as sort of companion, and they're finding Gemini 3 more engaging. You can't take it down the pub and buy a pint, would be my
It doesn't have a sarcasm, modern Keith.
yes. So, Gemini's growing faster is the bottom line. And it's leapt to the top of the AI download charts thanks to its video editor, Nano Banana. The number of firms saying they're using AI to produce goods and services actually peaked earlier in the year. Well, it seems to be recovering a bit. Interest in AI, according to Google Trends, also appears to have peaked. And it's not just Gemini 3. DeepSeek have quietly launched their latest model, and that has similar performance to GPT-5. Anthropic have released Claude Opus 4.5, which retains its lead in coding. But still, HSBC are forecasting that by 2030, ChatGPT will have 40% of the global population as a user base. And from that starting point, it estimates that its revenues will hit like 214 billion. And even assuming that it would fail to make a profit for a decade. So massive revenue assumptions, and it still fails to make a profit.
Somewhere their financial model should have a little sort of bit of AI in it that says this no longer computes.
Yeah, well, it's just and so that would make it this. So this is its expected cash burn, okay, before it gets to profitability. 140 billion. Well, just incredible. And obviously, Oracle is betting big and is committing to building all these AI data centers on the back of OpenAI's commitments, and how much of that is true. Like the Nvidia CFO has admitted the 100 billion mega deal from OpenAI still isn't signed. How much of this is all just hype? So, ChatGPT actually declines. The daily usage is declining, competition is improving, and perhaps the novelty is just wearing off, frankly. But according to Salary Fed, your AI is boosting US labor productivity. So this is productivity growth by sector. The ones with the highest productivity growth is information technology. But the equity market is less certain about the benefits of AI. Look at
There's
AI
a slow hissing
beneficiary.
noise, isn't there, Keith? Actually,
Yeah, absolutely. But the market's doing okay, which is your point.
yeah.
But AI investment, as we said, it is propping up the US economy, but not to the extent of, let's say, the dot-com boom.
Yeah.
But I think these data center forecasts are just fantasy land. You'll notice Oracle this week basically said that it was having to delay two of its projects because it couldn't get the either the staff or the equipment.
Yeah.
And market is and credit markets are concerned. So this is the Oracle's CDS, and that's leapt, but that implies only about a 9% of probability of default. So it looks bad, but in absolute terms, it's not actually that bad. But consumers, I thought this is a really good job. AI is being used, and
Yeah.
the adoption rate is, I'm actually using it quite a lot now.
Yeah,
Just
I use it, but I don't pay for it.
no, neither do I. Um, but this is, how much of this circular economy,
Yeah.
everyone just, Nvidia subsidizing OpenAI, who then make commitments to everyone else. No, so it's Christmas. And I thought I'd tell you this story, which is this chart reminds me of this story. Richard will attempt to censor this anyway. But the so when I was at uni one night, you know, we were trading most embarrassing stories. Okay, so I'll tell you two. I can only remember two actually. So one of my friends, well, bear in mind we're all like 18 at the time. Okay, so one of them. He's in the bath, and how can I put this? He's enjoying himself, eyes closed, and he finishes and opens his eyes, and there is a fresh cup of tea has been put just beside his head. His mum has come in with a cup of tea. But anyway, the story that I wanted to relate about this chart, the analogies with this chart, is that so another story is that once again in a bathroom, my, my mate of the time was giving himself a blowjob, and at this point we all said, You did what? He said, I was giving myself a blowjob. Can't you all do that? I said, no, we can't. Bad assumption. When his mom walked in and he'd forgotten to lock the door. And the analogy of this chart is, frankly, I think the whole AI industry is giving itself a blowjob. One day, their mum's going to walk in. And on that point, we'll move on.
Well done, Keith. I'll let you do any censoring you want to do.
Right. Okay. Okay. And that's it. So finally onto other charts. So Amazon have launched their Trainium 3, which again uses their own self-developed chips, which they claim are cheaper and more energy efficient than Nvidia. Nvidia's facing growing competition. I thought this is an interesting chart. So, internet traffic has exploded over the past 30 years. But when you look at the capex used to sustain that, it peaked during .com, so a long time ago.
Yeah.
And, finally, the joys of communism, politics, economics matters.
Yeah.
And good news. Well, I didn't know this actually, but this is news from February. In February, the fusion reactor in Cadarache, France, set a world record after sustaining superheated plasma for 22 minutes. That's a 25% improvement on China's previous record. And that the plasma reached temperatures of 50 million degrees. That's 3 times hotter than the core of the sun. Now, when we talk about energy and things that could come from left field, if we had fusion, you know, that would change absolutely everything.
It would indeed. Something to keep your eye on.
Yeah. So concluding comments. Well, it's been an absolutely extraordinary year. Merry Christmas, everyone. Tariffs, Trump's gold and silver to the moon. Congratulations to Richard. And thank you all for watching and sticking with us. Now, Richard has to go. But I'll quickly just go through some my own portfolio. So anyway,
Okay, thanks, Keith.
congratulations to Richard on an extraordinary year in which he has got everything right. So well done.
Which he's been lucky.
Yeah, no, well done, mate.
Thanks, Keith.
I
Bye-bye.
hope all of you listen to him rather than me. But quickly, I've been very active in the portfolio since I got back from skiing. I came to the realization that I was just, stuck mentally in my bond trade, which is just not working, and I had to actually get out of it and do something else. So I still think that UK interest rates will come down, and that will be good for bonds. And I'm not going to, cut it entirely, but I'm going to start buying other things, which I have been over the past few months. We talked previously about tin, so thank you very much to Simon W. and others for recommending Alpha Min Resources, which is listed in Canada. Now, its mine is in the DRC, and this big jump down earlier in the year was when political instability in the DRC caused a reduction in, well, the mine to be closed. So that is always a danger. So you shouldn't have too much of it. But fundamentally, we do not have enough tin in the world, and it's crucial to electronics. So, demand will remain high. So, frankly, I had a very stressful skiing holiday because I managed to forget my mobile phone, leave it in the car park at Luton Airport, and everything these days requires you to be incommunicado. So, while I was away, one of my REITs, which had been actually I was doing well on, had its annual results, and it reported that its NAV dip was down, but also its gearing had gone up. Its gearing had gone up to 70% above target, and the market took this very badly. The shares fell by about 15%. And the company announced that because its discount NAV was so high, that it would consider winding itself up. So there'd be a continuation vote in 2026. Now, the problem is when you have gearing of 70%, let's say your assets are 100, your debts are 70. So if you sell your assets at par at 100, you repay the debt at 70, the shareholders get 30. Yeah. Now, the trouble is that the NAV is generally sort of the best case scenario. And currently, we know there are a lot of renewable energy trusts attempting to sell their assets because the market doesn't appreciate them. So let's say you sell them at a 20% discount to NAV. So instead of getting 100, you get 80. Repay the debts of 70, shareholders get 10. So actually, they get a 67% discount to the NAV. Not good. So, frankly, I realized that the NAV was always the most optimistic estimate of what the assets of the value were worth. There are too many sellers, and I needed to sell any of these trusts where the investment case was predicated on the NAV. So I sold out of SDCL and ENRG and for the Gore Street Solar and the Gore Street Battery Fund and Labs, which is a biotech real estate play, where again you're selling real estate, hopefully towards NAV. But all of those were investment cases based on the NAV, and I got rid of a lot. And it's a good job I did, because this morning Gore Street came out with results, and they were bad. Shares down 15%. And so I have been putting the money into copper and tin, and I've also this morning I bought some for Expo. So anyway, but it's been an extraordinary year, one that I've played incredibly badly, and I've realised that I've been wrong. That there's no reason for the world economy to go into recession short term, and it's better to be nimble than to have these strong asset allocation views, which I've had and which have been totally wrong. So I'm given the past couple of years, thank you all for sticking with the podcast. I hope that going forward you are going to find it more valuable than you have in the past couple of years. In the meantime, have a Merry Christmas, and I hope to see you in the new year. And it's goodbye from me, Keith Jordan, and it's also goodbye from Richard Wheater. But goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.